Have you ever wondered if you should burn your annual leave or if you should save it as a lump sum? Which one is going to be taxed higher? If you've ever wondered the answer to that question, then stay tuned for this FERS Federal Fact Check. Hi, I'm Micah Shilanski with Plan Your Federal Retirement. And we have a great question that has come in today from Kevin that's talking about taxes, which you all know I love to talk about. Not only taxes, but going to be your annual leave and what you should do. Hello, PYFR team. I love the podcast and appreciate all the resources that you offer. My question is about taxes on the payout of annual leave for retirees. I assumed it would be considered income just like salary, and it would be taxed at whatever rate my income for me would be that year. But a colleague who is planning on retiring in a few months is planning to use all of his leave now because he thinks he'll be taxed at a higher rate. Bonuses are taxed at a higher rate. Are bonuses taxed at a higher rate, or is the amount withheld higher? Thanks so much. Kevin, that is a great question. And you are correct in your assumption, but there's some things that happen which makes people think it's going to be taxed higher. So let's walk through this. The answer to the question is no, bonuses are not taxed at a higher rate because you're getting a bonus or an annual leave payout. It's all based on the total amount of income that you've earned, right? We have this progressive tax system. The more income that you make, more you pay in taxes, not just in dollars, but in percent as well. That's going to come in. So once you retire, at the end of that year, how much income did you make? That's going to be one indication and dictate how much taxes that you have to pay. There's ways you can control that, but that's for a different question. All right, so let's talk about why do people think bonuses are taxed at a higher rate? And it has to do with when they're getting this income. So what happens when retirees, when do most people retire? At the end of the year. So they save up all of their leave, right? They have their full forward leave, plus they're saving up everything for the year, and they get this big cash out, big carry forward, right? Then they have this big cash out, which is going to come this next year. Well, when they get that cash out, what happens? That gets paid out in January. And the way taxes are withheld, it's that W-4 that you have to fill out on how much taxes you withheld from your paycheck. But the way that it works is this thing called a Circular E. It's on the IRS code of how employers are supposed to calculate this. And what they do is you get this large payout in January, and they're like, wow, this is going to be Kevin's normal check for the rest of the year. We have to withhold more taxes. So they don't look at it and say, oh, this is his last check, therefore we should withhold the same amount. They look at it just in the computer system way they're supposed to that says he's going to keep getting this. So they withhold a large amount of taxes on that annual leave check that you get. So people look at it and say, oh my gosh, this is taxed at a higher rate. It's not taxed at a higher rate. It was withheld at a higher rate, but you don't owe that. You might end up getting that money back. It really depends on where you shake out for the year. One of the things we talk about taxes, and Kevin, I'm sure you've heard before, is one of the confusing parts for retirees is you have income coming in from multiple sources. When you have this income coming in from multiple sources, what that means is not every source is going to talk to the other one in order to say what your annual pay is. So if you get $20,000 as a leave check, you get a pension of $30,000 that comes out. You get Social Security of $25,000 that comes out. Each one of those sources, and let's put TSP, you pulled out 40 grand. Each one of those sources that you have thinks that's the only income that you're getting. And so what happens most of the time, except for this last check, this one's a little different, but with the rest of the sources between your Social Security, your pension, your TSP, since they don't talk to each other, they withhold too little in taxes, and retirees end up owing more money at the end of the year. This is one of those rare exceptions that the way the Circular E works, the IRS code, the way it works on withholding is that because you're getting that leave cash out in January, they withhold a higher amount because they anticipate you're going to have more income for the year. So that's the why behind it, which I always find is fascinating. But no, it is not taxed at a higher rate. Quick little hack on this. If you're going to be in that situation, you don't want to prepay all these amount in taxes, you could always change your W-4, right? So they withhold less in taxes. That means you're going to have more withholdings, right? So they withhold less in taxes. And what's going to happen is they'll withhold less taxes. We like to do it in December before you get that annual check. But then just be really careful. Make sure you don't underpay the IRS because they can get a little punitive. Kevin, I hope this answers your questions. I really enjoy, especially when you guys have tax questions, I really enjoy you guys submitting your questions. When you have questions like this and how it pertains to your personal situation, pick up the phone and give us a call. Let us know about it, and you could be featured in the next FERS Federal Fact Check. Till then, happy planning.